Welcome to this seminar talking about Custodian Property Income REIT, which aims to be the REIT of choice for private and institutional investors seeking high and stable dividends from well-diversified UK commercial real estate. And we will unpack that mission statement as we go through the slides. But to start with, just an update on the commercial property market. And as this rather hopeful picture suggests, are we perhaps at the dawn of a recovery in the commercial property market? And is 2024 going to be the year of recovery? I think there's no getting away from the fact that the last 18 months have been very challenging. We've had inflation, rising interest rates, there's been a lack of confidence in the economy, and all property values are recorded as being down by about 30%. In our portfolio, that number is down 23% from the high in the summer of 2022. And we've seen the listed sector trading at fairly deep discounts, I suppose reflective of the high liquidity that that listed real estate offers. But what are the key indicators of brighter times ahead? Capital values are stabilizing. We've seen CBRE record values down only 0.4% in the first quarter of this year. And that compares to values being down nearly 4% in the 12 months to December 23. Vacancy rates are falling, sales volumes are forecast to increase, and we expect that income returns are going to be the dominant factor in total return forecasts. But the two big drivers of this recovery are rental growth, and we'll talk more about that as we go through. That's very evident in occupational markets. And of course, interest rates. Are they forecast to fall? But as we came into 2024, people were pretty hopeful about seeing an early cut in interest rates. But unfortunately, less than positive news around inflation has set that back. But I think it is still in the forecast, and certainly if you look at the forward curve for SONIA, it is forecast that rates will start to turn. And what has been very apparent is that there is significant amounts of capital waiting to commit to commercial property, but it's not going to commit until it sees very clear signs that interest rates are moving down. And in our space, the listed diversified property investment company space, there's been significant change. Leaving the sector through the last 18 months has been Columbia Threadneedle Property Trust that's merged with London Metric, Eddiston, which was sold to Realty Income following a strategic review. We currently have UK Commercial Property Trust, mid-talks for a merger with Tritax Big Box. Aberdeen Property Income has proposed to wind down the fund. Many of you might know that we did try and merge with API, but that didn't come to pass, so that fund is to be wound down. Palace Capital is 2 years into a wind down. The Balanced Commercial Property Trust very recently has announced a strategic review, and a continuation vote is scheduled for later in the year. And earlier in the period, we saw Secure Income REIT merge with LXI, and then in turn, both merge with London Metric. So who does that leave in the diversified property investment company space? Custodian, Picton, Schroeder Real Estate Investment Trust, and AEW. And over the next few minutes and looking through the next few slides, I hope to be able to convince you of the importance of a diversified strategy. particularly an income-focused diversified strategy, and particularly important for retail investors and for private client wealth managers. So to Custodian's investment strategy, it is unashamedly a diversified company and unashamedly focused on income. What we aim to do is to provide access to typically sub-institutional lot size UK commercial real estate, but in an institutional grade package. Why? To benefit from the high risk-adjusted income returns that this strategy can deliver. So we invest in UK regional, smaller lot size commercial property. We have a diversified portfolio of over 300 tenancies in 155 properties. We have always paid a fully covered dividend, and that has just been increased for the year in prospect to 6 pence per share on the back of earnings growth driven by rental growth. And that rental growth, which is the reversionary potential that we refer to here, shows a 15% potential reversion from a passing rent of £43 million to an estimated rental value of £49 million. And we'll talk about that a little bit more as we go through. So the headline question has to be, why do we bother buying smaller regional properties? Why do we bother building a portfolio of 155 properties? Diversification is one of the key reasons, and we'll talk about that in just a minute. But let me first talk about this graph, which is really central to our strategy. And what it shows is whole market data going back to 2000, looking at the net initial yield of properties traded in the market with lot sizes of under 10 million, represented by the red line, and over 10 million, represented by the blue line. And what it shows is until 2010, there was a fairly consistent margin of 65 basis points. Now, some might call that the risk premium for taking on that portfolio of a large portfolio of smaller properties. But in fact, an awful lot of the difference is just the hassle factor that people don't want to manage a large portfolio of small properties when they could have a smaller portfolio of larger assets. But there is some risk premium. Let's call the risk premium 50 basis points. What happened in 2010 and how has that margin maintained at nearly 150 basis points since 2010? Well, what we saw was a change in the investor strategies of the majority of the market. Most of the market was pursuing a strategy of larger primer assets, not least driven by the low cost of debt that enabled all players in the market to compete for those larger primer assets. And at the same time, many of those same investors were selling their smaller properties. So what we are seeing here is not a change in the risk profile of small and large properties, but a change in the supply and demand dynamics of the smaller and larger properties. So if the risk premium was in fact only 50 basis points, yet through the pressures of supply and demand, the margin has been 150 basis points, that suggests to me that by pursuing a smaller lot strategy, we can deliver 100 basis points of margin for taking no additional risk. And that's what we try and do, build higher returns without adding to risk. Of course, it's always possible to buy higher risk assets and deliver a higher initial income return, but that long run stable income return at a lower risk comes from pursuing good quality, smaller lot size assets in the market. And one of the other benefits, excuse me, of that smaller lot strategy is the lower volatility. And we saw this very clearly in the 2 years to the end of 2023, that very volatile period in the market, where large lots saw values move out by 40%. But the small lot size chart moved only 25%. So you can see you get not only the benefits of higher income return, but also lower volatility. So if we look back over our 10-year trading record, what do we see? Firstly, that ours has been an income-driven total return model. And you can see that very clearly in the NAV total return chart in the top left. And that very consistent progression with one clear aberration, which was 2022, where values grew very sharply and then collapsed on the back of rising interest rates and an ill-timed mini budget, which completely knocked the confidence out of the market. But actually, since the early part of 2023, returns have been much more stable. But as I say, largely driven by that recurring income. In the top right, again, you can see NAV shown by the red line, and the blue line shows the net initial yield of the Custodian property income REIT portfolio. Unsurprisingly, as NAV values went up, NAV went up. That's because yields were falling. But they have recovered, and the NAV, the EPRA topped up net initial yield for the portfolio now sits at 6.5%. And that's a really important number. And again, I'll revisit that in a moment. Bottom left, you can see the rental reversion. So this is the estimated rental value versus the passing rent of the portfolio. So the total rental growth potential of the portfolio. You can see how that really started to build in 2020, 21, 22, to sit today at almost the highest it's been in our 10-year history, 15% potential upside. And what does all that mean for performance? The average annual net asset value total return Custodian property income REIT has been 5.9% per annum. And we believe that NAV is poised for a recovery, supported, as I say, by rental growth. So this makes this really an opportune time to invest. I said we were all about income, and you can see it here in this chart. The red bars show earnings per share, and the blue bars show dividend. And over the 10-year period, we have worked on the basis that it is our job to get rent and therefore earnings into the hands of shareholders through the dividend. And we have paid out between, we've had cover of 100 to 116%. So we don't sit on huge margins of earnings. We try and get that paid out as dividends. And a recent example of that is in the trading update announced just early this month. We have increased the dividend per share from 5.5 pence to 5.8 pence for the year to March 2024, and for the year in prospect to 6 pence per share. And we've been able to do that because rental growth and falling vacancy rates are forecast to enhance earnings such that we will continue to be able to pay a fully covered dividend out into the future. Based on a share price of around 80 pence, which seems to be where share price has been oscillating of late, that gives a prospective dividend yield of 7.5%, which I think is a fantastic entry point into a recovering market. This is a chart that's really important. And it's become important as we've moved into a higher interest rate environment. When interest rates were virtually zero, it didn't really matter. We could have bought pretty much any property and seen a margin over the cost of debt. But just to explain what you're looking at, the blue line is the net initial yield of the portfolio. The red line shows that reversionary potential. so the total potential income from the portfolio, and the grey line is the company's weighted average cost of debt over the last 10 years. And while you can see it has been increasing recently, so too has the yield from the portfolio. So we have managed to maintain a pretty wide margin over the weighted average cost of debt. What does that mean? It means that the Custodian property income REIT model works in a higher interest rate environment. Debt is still accretive to the earnings of the company. And as we see that rental growth dropping in, we think that position will continue into the future. So if we're all about income, let's just consider for a minute the security of that income. We have the portfolio split between the main commercial property sectors. This split is by reference to the estimated rental value of the portfolio as a whole. So 41% of that potential rental value comes from the industrial and logistics sector, 22% from out-of-town retail or retail warehousing, 16% in offices, 8% from the high street, and 13% in the asset class that is unhelpfully called other. And what other means in property terms, sometimes referred to as alternative, it means that it's not industrial, it's not retail, and it's not office. So for us, it's car showrooms, it's, as you can see here, drive-through coffee shops. We have children's day nurseries, restaurants, hotels, broad range of commercial properties that don't fit into those three traditional commercial property sectors. Why are we weighted to industrial and retail warehousing? Because that's where we believe the greatest reversionary potential is. Across the portfolio, modern real estate, I think one of the myths that we need to dispel is that by buying smaller lot size regional property that somehow we aren't buying good quality property. But you can see from these images, this is modern, fit for purpose real estate in demand from tenants, and we will look at tenant quality in just a minute. With a smaller lot size strategy, you necessarily build in greater diversity into the portfolio. And as I said, over 300 tenancies. And what this chart is looking at is the amount of income that's paid by any one tenant in the portfolio. And as you can see, even amongst our largest tenants, Menzies, Wickes, B&M Retail, we've actually got multiple properties. So we have 8 properties let to Menzies Distribution, 3 let to Wickes, 3 to B&M Bargains, 2 to B&Q. So there is further diversification behind the pie chart that you can see. But what it means is we have no one property let to a single tenant that represents more than 1.5% of the rent roll. So genuine diversity. And you're going to recognize a number of those tenant names on the right. These are good quality, mainstream UK businesses. And when you look at tenant quality, because again, another myth that needs dispelling is that perhaps we have lower quality tenants because we are targeting smaller properties. And again, that's not true. And this is by reference to an Experian credit rating, the tenant risk rating of our portfolio. And what it shows is that nearly 80% of the portfolio is let to tenants who have a lower than average risk. Now, those of you who have a glass half empty mentality might be looking at the right-hand end of the chart. But actually, this is where we often find opportunity. Tenants who might once have been strong, who have had a tough time, maybe have gone into administration. We've seen company voluntary arrangements at that end of the portfolio. That's our opportunity to get the properties back and to invest the money in those properties that has probably been lacking as a result of the tenant struggling, and to move those properties on. And we've seen some really positive examples of how we can bring our asset management capability to bear on that end of the portfolio to turn those assets around. I said we'd talk about reversionary potential and perhaps try and give a little bit more colour to this 15% reversion that you can see in the chart on the right. What makes up the increase in rent? Well, some of it is just latent rental value that will drop in through new lettings, rent reviews, and some of it is void estimated rental values. That is properties that are currently not let. But we are seeing real progression on the letting of that vacant space, really recovering from the vacancy rate that increased as a result of COVID. And we are seeing much more of a return to normal now. And with deals agreed, we expect to see that vacancy rate fall from 8 to 4% over the next few months. And then looking on the left-hand chart, it perhaps gives you a more nuanced look at how we expect, and this is a forecast, so while it's based on independent estimates of rental values, it allows for forecast vacancy and reletting, tenant incentives. So it's not a straight line from 43 million to 49 million, as you might expect. But you can see strongly positive growth over the next 4 years, taking us to 44.5 million by February 28. But in a rising market, and is there still a rising market for rental growth, you would expect, and we are seeing, that we are agreeing terms ahead of the forecast estimated rental value, because necessarily the estimate of rental value is based on deals that have already been done. So we have tended to outperform our estimates of rental value. Balance sheet strength, of course, essential to any business, and we've touched already on the weighted average cost of debt and how that sits against the net initial yield of the portfolio and the reversionary potential of the portfolio. On the left, there's a chart that shows the 4 tranches of debt that we have, 3 tranches of fixed rate debt with SWIP and Aviva, and a Lloyd's revolving credit facility. The weighted average cost of that debt is 4.1%. The weighted average term of our fixed rate debt is 5.5 years, with the first refinance point in the summer of next year, which is a £20 million SWIP fixed rate facility, currently fixed at 3.94%. Now, interestingly, given a look at the forward curve for SONIA, which you can see on the right-hand side, at that refinance point on current forecast, SONIA, 3-month SONIA is forecast to be 4.25%. Typically, we can secure a margin of around 150 basis points. So that would give us an all-in cost of debt of 5.75%. Yet our portfolio initial yield is 6.5%. So it is still going to be accretive, albeit at a slightly higher cost. But mitigating against that higher cost of debt is more rental growth dropping in, falling vacancy rate. So we believe that the debt will still be accretive and affordable as we hit that refinance date in 2025. So in summary, a diversified portfolio is there designed to mitigate market risk, to mitigate the one sector outperforming and one sector underperforming. It's weighted towards industrial and logistics because that's where we think there is the greatest reversionary potential. Now, we have been terribly conscious that diversified strategies have been less fashionable of late, with many investors focused on single sector, or often called pure play strategies. And those single sector funds, when they have the wind at their back, can outperform. But let's not kid ourselves, they are higher risk. Being in a single sector is higher risk when the drivers of growth in that particular sector fall away. And a diversified fund is designed to mitigate against those risks. We focus on sub-institutional lot sizes in order to get that yield advantage and to enhance earnings so we can pay out a higher fully covered dividend. And we do that all with a resilient balance sheet. We think 2024 is going to be a turning point. At the start of this year, I think we thought it might be the summer. As we've gone through the year, I think that turning point is moving to later in the year. But we've had a successful first 10 years of trading, acknowledging that this is a low point in our share price. I think that coincides with a low point in market confidence. And to use a much hackneyed phrase, it is always darkest just before the dawn. And it feels like we are at the dawn of a market recovery. We tried to merge with API this year. We weren't successful, but we have been successful in the past, acquiring Drum Income Plus REIT in 2021. And we are still alive to the opportunities for growth through corporate acquisition. But we also believe that we can see a recovery in share price and get back to growth through issuance that saw us grow so strongly through the first years of trading. Thank you very much.